In the last few days, you've felt it every time you drive your car. Gas prices are suddenly spiking, and your wallet is feeling the pain. At the same time, the stock market is flashing red, and the headlines are screaming about a new war in the Middle East. These things are not a coincidence. What's happening right now is a geopolitical shockwave that could send gas prices to levels we haven't seen in years and potentially tip the economy over the edge. But how bad could it really get? And is there a massive market crash right around the corner? In this video, we're going to break down the truth about these soaring gas prices, what it means for your money, and reveal the one critical fact that nobody is talking about. Stick around. So, what kicked all of this off? On June 13th, the long-running tensions between Israel and Iran exploded. Airstrikes were launched, targeting not just military sites, but for the first time, critical energy infrastructure. The US was quickly drawn in, and global markets panicked. Immediately, the price of crude oil, the raw ingredient for the gasoline you put in your car, shot up. But here's the first thing you need to understand: the market isn't just reacting to what's happening now. It's reacting to what could happen next. Traders have added what they call a geopolitical risk premium of up to $10 a barrel. Why? Because they're terrified of one thing: the Strait of Hormuz. Think of the Strait of Hormuz like the main water pipe for the world's oil supply. About a quarter of all the oil traded by sea has to pass through this tiny choke point. Iran is threatening to turn off the tap. And if that happens, analysts at JP Morgan and Goldman Sachs warn that oil prices could skyrocket to over $120 a barrel. Okay, so a crisis overseas is making oil expensive. But how does that translate to the $3 and change you're now paying at the pump? Let's break down a gallon of gas. As you can see, over half the price, around $1.76 of a $3.20 gallon, is just the cost of crude oil. That's the direct connection. When oil gets more expensive, so does gas. It's that simple. But right now, we're in a perfect storm. This geopolitical shock is hitting at the exact same time that gas prices naturally go up for the summer. Refineries have to switch to a more expensive summer blend of gasoline to meet environmental regulations, and demand goes up as we all start driving more for vacations. These three forces are combining to create maximum pain at the pump. And because most of us can't just stop driving overnight, prices can swing wildly. But this isn't just about your commute. High gas prices act like a tax on the entire US economy, and they're a major headache for the Federal Reserve. Higher energy costs are a primary driver of inflation. Think of inflation like a slow leak in your tire. It gradually reduces your purchasing power, meaning every dollar you have buys a little bit less. A sustained spike in gas prices could force the Fed to keep interest rates high, making mortgages, car loans, and credit card debt more expensive for everyone. And here's something the headlines might miss. You might see a report that says retail sales are up and think the economy is strong. But you have to look closer. That increase is often just because everyone is forced to spend more money for the same amount of gas. When you look at what economists call control group sales, which strips out gas, you see that spending on everything else is actually flat or going down. It's a hidden economic slowdown. So what does all this mean for the stock market? Well, Wall Street hates uncertainty, and this crisis has created a lot of it. The Dow, S&P 500, and Nasdaq all took a nosedive when this news broke. But the market isn't falling evenly. There are clear winners and losers. Energy stocks like Exxon and Halliburton have soared because they make more money when oil prices are high. But on the other side, airline stocks have been crushed by higher fuel costs, and retail stocks are down because investors know you'll have less money to spend at their stores. This shows how a single global event can instantly ripple through your 401k or investment portfolio. By the way, if you're finding this breakdown useful, do me a favor and hit that like button. It really helps the channel. Now, here's where the story gets really interesting. So, we have a market in a full-blown panic, with traders betting on a worst-case scenario. But now for that critical fact I mentioned at the beginning, the one that complicates this whole story. Despite the fear, the price spike, and the headlines, the oil is still flowing. That's right. According to the International Energy Agency, there has been no major disruption to the actual supply of oil from the region. This means the current high gas prices are being driven almost entirely by fear, not by a real shortage. And it gets better. Looking long-term, major institutions are actually predicting that oil prices will fall. The IEA says the market looks comfortably supplied for the rest of the decade. And analysts at JP Morgan are forecasting that oil will drop back to the $60s in 2025. This is the central battle in the market right now, short-term geopolitical fear versus long-term supply fundamentals. What happens next depends entirely on whether the conflict escalates or de-escalates. The market is on a knife's edge. So what's the takeaway for you? First, understand that the price you're paying at the pump today is inflated by a massive dose of fear. While the situation is volatile and could get worse, the underlying fundamentals suggest that these high prices might not last forever if a wider war is avoided. It's a powerful reminder to always look past the headlines and understand the real drivers of the market. This situation is changing every day. To stay updated with clear, no-hype analysis on how it affects your money, make sure you are subscribed to the channel and have notifications turned on. And finally, I want to hear from you. How much have gas prices gone up in your city? Let me know in the comments below. Thanks for watching.